So, those two questions I used to start every class off, like the first 5 sessions. I think it's time I ask those questions again, because I have a sneaking feeling that for some of the answer is no still. Have you picked a company yet? I hope you have, right? If you haven't, don't let me know. I don't want to know right now. Act like you have. If you haven't picked a company, obviously you didn't turn in a DCF for feedback, so that part didn't go well. But I'll tell you what, I'll keep the window open. So if you get a DCF done at any point in time, you just want quick feedback, send it to me, because I know this is, for those of you who kept the deadline, you're saying this is so unfair. This is one of those things where it doesn't really hurt you, it helps somebody else. So I'm opening the window again. But you know what this week's valuation of the week is going to be, right? It's going to be Uber. Okay, I put up my Uber valuation and post yesterday. And what I want you to do is really give this a shot, because this is going to be a high-profile IPO. And I don't want you to reflect my value. I have my story and my value. I've created a spreadsheet there. And one of the things you're going to see in a spreadsheet is a very different way of approaching valuation than what we've done so far, which is top-down, where we project revenues. I do that for Uber as well. But I also value a rider. What's the value of a rider to Uber? Think in DCF terms. What's the value of a rider? It's a present value of the expected cash flows from the rider. So to get those expected cash flows, what are some of the things I need to know? One is I need to know an expected lifetime that a rider is going to stay on. I need to know your renewal rate that you will stay on as rider. I need to know how much gross billing a rider brings in, how much that will grow, and I need a discount rate. DCF is not the reason you can't value riders, just that the information is messy. So I value a rider for Uber. And I come up with a value of about $470, $480 per rider. How many riders does Uber have right now? Anybody have a guess? So none of you have been reading the prospectus over the weekend. I thought that's what you'd be poring over. Okay? They have 91 million riders right now. 91 times 478 gives me about $44 billion. That's the base. Am I done? What do I have to factor in next? New riders that they might add on. And to value those new riders, I need one additional piece of information, which is what the cost of acquiring a new rider is. So I value a new rider at about $370. And I make some assumptions about how many new riders. You're saying, how do you know that? I don't. It's my story. I'll tell a story that... So I expect them to more than double their riders to about 215 million in 10 years. I come up with a value for the new riders of about 60 billion. Am I done? That takes care of existing riders, new riders. You're saying, I'm done. The only problem is there are expenses unrelated riders, like what the R&D expenses, the G&A expenses, the corporate expenses. That's still untouched. This is a problem with building up. You've got to mop up loose ends. I take the present value of those costs. That knocks about 50 billion off the value. You're saying that's a lot of money. It's a lot of expenses not related to riders. You bring them all together, you've got a value for the operating assets. Am I done? I'm getting closer, but here's the problem with Uber. I still have to add cash, that's the easy part. I have to add the proceeds they're going to get in the IPO, which right now I'm pulling from rumored numbers because we actually don't know fully yet, but it looks like it's going to be about 10 billion. Am I done now? Do you remember what's happened to Uber in Asia in the last 3 years? What have they done? They've exited from China, exited from Southeast Asia, and well, this is not Asia, they also exited from Russia. You're saying that's, so they're done, right? But when they exited from China, what did they get in return for exiting and leaving the market to Didi? They got 20% of Didi. When they exited Southeast Asia, they got 23% of Grab. When they exited Russia, they got 38% of Yandex Taxi. So to complete my valuation of Uber, what do I need to do? Need to value 3 private companies with 0 information. I threw up my hands. Hey. The way I valued them is I took their riders and I have a value for Uber and I kind of scaled the value to what their net revenues are. And that adds another 9 billion in cross holdings in those 3 companies, mostly from Didi. And Uber has about 6.5 billion in debt. I get a value of equity and a value per share. That's my story, my value. That spreadsheet is there, so you can go play with it, change the number of riders, change the customer acquisition costs. And I actually have a table in the post where I show the value of Uber as a function of how much growth in revenues they can get per rider and how much the cost of acquisition is. And to me, the driver of Uber's value is not how many new riders they add. That's important. Much more critical is they get existing riders to spend more money. That is going to be the, if they can do that, then I can see a pathway to the 100 billion they're talking about. If they cannot do that, they're completely and totally screwed. Because this is a business where it's going to be really tough to make money. So what I'd like to do is every one of you to try it. Because I told CNBC I'm not coming this week. I have enough of a bad reputation already. I'll wait around the IPO date and then I'll show up. And you know what I'm going to come with? I'm going to say, look, I'm not going to bring you my valuation. I have my classes. Because remember, I compute the median and the average. This way, if something bad happens, it's your fault. Right? So I don't want any more of this response. I've heard from a few people at Lyft blaming me. One Lyft driver that I took in London said it was my fault. No, actually, it couldn't have been London. It must have been New York, coming back from the airport. No. Was complaining about the stock price, and I didn't even want to talk to him about it. I just said, let's let it go. It's not your problem. It's somebody else's problem. But hey, I can use your crowd pricing or crowd valuation. Incidentally, I also did a pricing of Uber. And who did I price them against? Lyft. It's like jumping back and forth between the two. What do you think I used as my metric? I tried PE ratios, but it did not work. I tried EV to EBITDA, did not work. Why? Negative, 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 negative. I kept climbing. I divided by net revenues, and I came up with a multiple. And based on the net revenues, Uber's value is about 108 billion. So if I use a pricing against Lyft, I can get up to 108 billion. I also looked at enterprise value per rider, per ride, per city, per driver. You see, you can't do that. I can divide by any number I want. And if that's what they're going to scale by, pricing is a pragmatic game. It's a game of what's the market using. And right now we have only a sample of 2, but as Didi comes on and Grab comes on and Ola comes on, we're still going to start to see what markets focus on here, at least initially. Okay? So when you get a chance, open that up, because we're going to start today with a pricing issue. Okay? Let's start with a very simple exercise. Let's suppose you have 3 companies in the same business. They have the same cost of equity. And we're going to draw on what we did last session about what is it that drives multiples. Let's see if it's stuck. Company A has a return equity of 12%. Company B has a return equity of 10%. Company C has a return equity of 8%. If I told you one of these companies is trading at less than book value, which one is it going to be? It's going to be C. Why? Because the return equity is less than the cost of equity. That's the driver of price to book ratios. Now assume though, and this is where it gets tricky, that the company which has a return equity of 8% decides to take a write-off, which is going to take off half of book value. Overnight, what's going to happen to its return equity? It's going to 16%. What's going to happen to its price to book ratio? It's going to 1. It's essentially going to go up above 1. They're both going to go, as long as you use both together, you're going to be okay. But if you just focus on one number, not the other, just the price to book, it's very easy to get into trouble because you're missing what I call the companion variable, the variable that best explains variations in that multiple. Let's move on. Let's suppose that you're looking at enterprise value to sales ratios. Remember, that's one of the multiples you threw into the mix the last session. And you're looking across retail companies, and you're trying to pick companies based on which ones trade at a low multiple of revenues. So which of these four groups is going to look cheapest to you? Department stores, discount retailers, luxury retailers. What is it about discount stores that's going to give them low EV to sales? It's low margins, right? It's a pricing model. It can be a Costco or a Walmart can never trade at a huge multiple of revenues. Why? Because they have low margins, high volume. Remember, that's still a very viable business model. You can be a very successful retail company with a low EV to sales and a very unsuccessful retail company with a high EV to sales because you sell almost nothing. So when you look at margins, that's going to give you a sense. So again, if you're not watching, you're going to find all discount retailers look cheap to you and all luxury retailers look expensive to you. That's why you need to bring in margins. And finally, if you want to see the power of a brand name, this was way back in time, but I'm sure the numbers still look similar. I took a bunch of smartphone companies and I computed, or somebody computed, the margins in each of these companies. So just take a look at that as you go through time. This is through 2011, but I'm sure if you pull through 2018, the numbers will look that different. You're looking at operating margins across the sector. Okay. There are two companies that stand out. One really stands out. Apple's operating margins are almost 30% plus, and Samsung's are 17%. Samsung's has slid since 2011 substantially. Its margins are down to 6 to 7%. Apple's margins have surprisingly held up. In fact, that's what's kept Apple's market cap up. Is after all, it's a smartphone company, but its margin, and as an investor in Apple, this becomes the number that's going to determine whether you think Apple can sustain its values, whether those margins can continue to hold up. So my point is, as we go through the pricing process, I want you to think companion variable, because here's what I'm going to do for the rest of this class. I kind of warned you yesterday in the email that this was what was going to happen, but now I'm going to let it happen. Okay? Let's talk about what drives each of these multiples. And you're going to see these companion variables pop up as we go through. So let's move on to a variant on the PE ratio. One of the problems with PE ratios is high growth companies have high PE ratios, low growth companies have low P's. We kind of established that. And if you're an investor who picks stocks based on low PE ratios, you will never find a growth stock in your portfolio. And think of how much you'd have lost by doing that, right? All the great companies of the last 25 years that were growth companies would have never made in their portfolio. So growth investors have always struggled with how can I adapt the PE ratio so that I can still find a way to buy growth companies. So one of the first great growth investors, at least in terms of people getting to know him, was Peter Lynch. And Peter Lynch, which was the mutual fund that Peter Lynch essentially built up from nothing to become one of the most successful and largest funds in the world. It's Fidelity Magellan, the very first growth mutual fund that kind of essentially became big. And Peter Lynch brought discipline to that process because before him people invest in growth stock, but they just looked at high growth rates. And Peter Lynch said, that's not going to get me anywhere because if I just buy high growth companies and they have really high PE ratios, I'm not getting cheap stocks. I'm going to look at the PE ratio relative to growth. And he actually, if you look at Beat the Market, which was his book about how he picked stocks, he talked about looking at the rate of growth in PE ratios and the rate of growth in the growth rate and saying, I'm going to pick companies where the growth rates are going up more than the PE ratio is. And what he said essentially got at least in the way equity research analysts played it out, was converted to a ratio. Where analysts said, why don't we look at the ratio of PE to growth rate? It's called the PEG ratio. Nothing fancy. So if your PE ratio is 20 and your growth rate is 25%, 20 divided by 25% is 0.8. So your PEG ratio is 0.8. Again, like the PE ratio, you want a low PEG ratio. And the original rationale analysts had for using PEG ratios is by doing this, we don't have to worry about growth anymore because we made growth go away by bringing it into the equation. So my first stop was to see if that was true. By using a PEG ratio, are you making growth go away? And it's actually very easy to answer the question. Because remember how we computed the PE ratio from an intrinsic PE equation? I took that PE ratio and I divided that PE ratio by the growth rate. And there you have the equation for I have a pointer after 9 weeks of being too lazy to replace my pointer. I finally got a pointer that actually works. Is That is the equation in a two-stage dividend discount model for the PEG ratio. I'm going to ask you a stupid question, but humor me. Is growth gone? If these analysts are right, growth should not be in that equation, right? It should be gone. It's not gone. It's everywhere. It's in the numerator. It's actually messed up every conceivable way I have of telling you what will happen to the PEG ratio as growth changes. I don't like PEG ratios, and I'm going to explain why. But one of the reasons I don't like PEG ratios is this really complex relationship I've created between PEG ratios and what happens to growth rate. Rather than talk in abstractions or ask you to do calculus, here's what I'm going to do. I'm going to go back to that abstract example that I used to illustrate PE ratios. Remember I said I'm going to give you a high growth company with, did I miss the page? With a growth rate and compute the PEG ratio. We're going to see with PEG ratios where that leads us as we change individual variables. Okay? So when you look at PEG ratios, here are the things you're going to see. Two variables, it's going to be very easy to tell me the relationship. The first is, as risk goes up, you're going to see the PEG ratio go down, because for any given growth rate, higher risk companies will have lower P ratios. That's going to be the easy one. As return on equity goes up, PEG ratios will go up because your growth is more efficient. So risk and return on equity are going to be pretty easy. But as growth changes, you're going to struggle with what will happen to the PEG ratio, because you've really messed up that relationship between PE and growth. So here's the company that I'm going to use this to illustrate this process. It's a high growth company. It has 5 years of growth at a 25% growth rate, and during that period it's going to have a 20% payout ratio. I'm going to keep things simple, assume the beta is the same in both periods. After the high growth phase, it's a stable growth company with an 8% growth rate and a 50% payout ratio. You can afford to pay out more because the growth rate has dropped. I'm going to plug the numbers in and come up with a PEG ratio for this company. So using the cost of equity of 11.5% in these parameters, plugging in, I come up with a PEG ratio of 1.15. If this company is fairly priced, its PEG ratio should be 1.15. But remember, with the PE ratio, once we did this, we asked what if questions. What if this changes? What if that changes? Let's take this PEG ratio and first see what will happen to it as I increase the risk. As I make my beta go from 1 to 1.25 to 1.5 to 2, notice what happens to the PEG ratios. They go down. Higher risk companies will have lower PEG ratios. If you get a chance, pick up some equity research of tech companies, because some analysts use PEG ratios. And one of their favorite devices for showing a company is undervalued is they'll show the PEG ratio for the company and the PEG ratio for the S&P 500. And they'll say, look, this stock is cheap. It's trading at 0.8 times, the PEG ratio 0.8, but the S&P 500 trades at a PEG ratio 1.1. What's the flaw in that comparison? This is a risky company. It should trade at a lower PEG ratio. So first stop is, when you look at a low PEG ratio, you want to make sure it's not coming from high risk, because that's exactly what you should expect. Second, I said, what will happen to the PEG ratio if I can deliver growth more efficiently? So the way I look at this is, how much of your earnings are you returning, or in this case, retaining in the firm to get the growth rate? And the less you retain to get the same growth rate, the more efficiently you're delivering growth. I could have done this graph with the return on equity, and I've got exactly the same answer, because remember, return on equity, growth, and payout are all linked up. And what do I find? No surprises again. The more efficiently I deliver growth, the less I have to retain to get that same growth rate, the higher the PEG ratio is. So lower risk and higher return on equity. Okay? And finally, I looked at the growth rate, and my stomach dropped when I saw this graph. Because here's what I saw. Initially, as growth increased, the PEG ratio decreased. And then you get to a point where as the growth increased, the PEG ratios start to go up. You're saying, so what? Remember with PE ratios, we talked about your perfect cheap stock. Help me out. What do you need with PE ratios to find the cheap stock? You want low PE. You want, in terms of growth, high growth or low growth? You want high growth. You want low risk and high return equity. So with PE, I can list the variables. Help me out with PEG ratios. If I want to look for a cheap stock, so you're in Capital IQ, you can actually get the PEG ratios for stocks. So first you want low PEG ratios. That was easy. Low risk or high risk? You want low risk, because otherwise you'd explain. So you want low PEG ratios, low risk. Low return equity or high return equity? You want a high return equity. So you want a company with low PEG ratios, low risk, high return equity. Low growth or high growth? Now, It depends, and that's the problem. If it depends becomes your answer, your pricing just got a lot more difficult. So let me list out the propositions, and let's think about a way in which you might be creatively able to screen. I just think it's a horrible multiple. It should be banned. But given that's in use, here are my basic propositions. First is, high-risk companies will have lower PEG ratios than low-risk companies. Second, high return equity companies will have higher PEG ratios than low return equity companies. But with growth, companies with very low or very high PEG ratios, remember the two ends of the extreme, will tend to have higher PEG ratios than companies right in the middle. So you know what you're looking for, right? You want to get companies where the deviation from the average growth rate is small. So there's a pain in the neck. You'd have to compute the average growth rate in your sector, look at the differences, and that's really what you're going to use as your third screen. It's not going to be a great screen. So when you see PEG ratios, hold back on the applause, because while it looks like it adjusts for growth, it does a very shoddy job of explaining the growth. You want to make sure that your company, if it's cheap, has a growth rate very close to the, in this case, you want it to be either extreme, not very close to the average, because you want to make sure you have nothing that explains away the low PEG ratio. Let's move to price to book. By the time I get to the fourth multiple, I hope you're getting a sense of what we're doing. It's an equity multiple. What do? I go back to a dividend discount model. You can use a two-stage model if you have variables, like if you have something like PEG ratios, where high growth is part of the equation, or you can go back to a stable growth model. With price to book ratios, we know what drives the value of a stock, right? So basically, we go back to a dividend discount model. The value of a stock is expected dividend divided by cost of equity minus the growth rate. So Gordon growth model, oldest model out there. If I divide both sides of the equation by the book value of equity, here's what I end up with. Price to book ratio is a function of return equity, payout ratio, cost of equity, and growth rate. Notice the variable that popped up when I did price to book. With price earnings, the variables were growth, payout, and cost of equity. When I put in price to book, return on equity pops up. When I talk about companion variables, that is your companion variable. It's price to book, it's return equity. And basically, if I take out the 1 plus d and make it next year's return equity, the price to book ratio for a company is a function of its return equity, its growth rate, its cost of equity, and its payout ratio. I'm going to actually simplify that. Because if this is a stable company, what should the growth rate in this company be? It should be the 1 minus the payout ratio times the return equity, right? So retention ratio times return equity. And if I plug it back in, I end up with the price to book ratio for a stable growth dividend paying firm. And guess what? It's a function of return on equity minus growth in the numerator, cost of equity minus growth in the denominator. Remember that example I showed you? We had 3 companies with very different returns on equity. If you're a company that I expect to earn less than your cost of equity in perpetuity, you will trade at less than book value. It doesn't make you cheap. You will trade at less than book value. You know what the pushback you get is? Why don't you just liquidate the company and get book value back? You must have more faith in book value than I do. Because if you liquidate the company, there's almost zero chance you're going to get the book value back. But you will trade at less than book value. So you're valuing Deutsche, or you look at its price to book ratio, what should you expect to see? Very high or very low?
Book value equity, right?
Price to book ratio, what should you expect to see? A very low price to book. Why? Because its return equity is abysmal. You're saying, hasn't it book? Remember, it's a bank, so the book value of equity is still kept inflated with inflows. Its price to book ratio is well below 1. And you know what? It deserves to be well below 1. And if I move from price to book to enterprise value to invested capital, it might sound like a very different multiple. But remember, the enterprise value multiples, I go back to an enterprise value discounted cash flow model. Again, keep it stable growth. There's my value of the firm in an enterprise value model. Do the algebra. Enterprise value to invested capital is a function of return on capital minus cost of capital. Return on capital minus growth rate divided by cost of capital minus growth rate. Notice if you can get one multiple using equity, you can always get the analogous multiple. So with enterprise value invested capital, the companion variable is return on capital. Low return on capital companies will end up trading at well below invested capital. So now that we're on this path, let's keep moving. What about enterprise value to EBITDA? I told you this is a multiple that you hardly ever saw in equity research and valuation in the mid-'80s. It's kind of taken off for good reasons and bad. And that enterprise value to EBITDA multiple is now used in about a third of equity research. So let's say you're an equity research analyst and you have to use EV to EBITDA. Everybody in your group does. So you're saying, what are the variables I need to control for? Let's go through the algebra again. Let's start with a discounted cash flow model. But here I'm going to do a little trick that's going to make my algebra a little simpler. Remember in a firm valuation model or an enterprise valuation model, you take your expected free cash flow to the firm next year and divide it by the difference between cost of capital and growth rate. That's the standard equation. I'm going to actually take your free cash flow to the firm and rewrite it. Sounds like it's something different, but I'm actually just staying within the old confines. But I'm going to write it in terms of EBITDA. So normally we take EBIT times 1 minus T plus depreciation minus capex minus change in working capital. Here's what it looks like in terms of EBITDA. It's EBITDA times 1 minus T plus T times depreciation. That's the tax benefit from depreciation. It's exactly the same. If you don't believe me, take a company and work it out, you get the same number. I divide both sides of the equation by EBITDA. So here's what I'd like you to think about. Forget about the algebra. Think about as an investor, I'm coming to you with a stock with a low EV to EBITDA. This equation is going to tell you what questions to ask me. Okay? So let's start with the first one, 1 minus T. So what does that tell me? The higher my tax rate, the lower the multiple of EBITDA I should be paying. So if you're looking at the enterprise value to EBITDA for an Irish company, it should be much higher than the EV to EBITDA for, I don't know, a German company. Simply because why does tax rate come into play? With PE ratios and price to books, we didn't seem to care. Why with EV to EBITDA do I suddenly start caring about taxes?
EV includes debt value also, and debt gets taxed.
Well, that might be, but that always, even with equity, that gets a tax benefit too, right? So when I did net income, I didn't care about the tax rate. Why did I not care about the tax rate?
It is taken, but you're seeing the number after the tax.
Net income is already after taxes. If I have a really high tax rate, my net income is already low. If you climb above your tax number, you have to worry about tax rates. Why do you think I can't put a number on Aramco yet? Because the tax rate is unspecified still. Until the Saudi government gives you a tax rate and says, this is what we will take out of your income, I can't put a number on it. It's impossible to do. You think, why? They have lots of reserves. Okay, you have lots of reserves. What if the tax rate is going to be 100%? I know it sounds absurd. I will pay nothing for the company because you're going to take all my earnings away. So the higher the tax rate, the lower the EV to EBITDA. If you go to the denominator, you have two other variables, cost of capital and growth rate. The higher your cost of capital, the lower your EV to EBITDA will be. So if I'm looking at EV to EBITDA across companies, I would expect the EV to EBITDA for Russian companies to be much lower than the EV to EBITDA for Northern European companies. Why? Because there's country risk in your denominator, higher cost of capital. The higher your growth rate, the higher your EV to EBITDA. So far, the mechanics look very similar, right? So basically you worry about tax rates, you worry about cost of capital, you worry about the growth rate. See these last three terms, I'm going to net them together. Depreciation, capex, and change in working capital. If I consolidate those numbers, capex minus depreciation plus change in working capital, what does that give me when I do value? That's my reinvestment, right? So what this equation is saying, the more I have to reinvest to get any given growth rate, the lower the EV to EBITDA should be. So let's try this out with a company. And I'm going to keep the company simple, just to keep the math simple. So I'm going to start with a company with a 36% tax rate, 30% capex as a percent of EBITDA, 20%, depreciation is 20% of EBITDA. Cost of capital is 10%. For simplicity, let's assume there are no working capital requirements and that this company is a stable growth company growing at 5% a year. If I plug the numbers into my equation, my EV to EBITDA for this company, if it's priced correctly, should be 8.24 times EBITDA. That's not a pricing, it's just an intrinsic valuation stated as a pricing. Okay? So once I get that number, I can ask what if questions. So here's the first question asked. As the tax rate goes up, what happens to my EV to EBITDA? No surprises. The higher my tax rate, the lower my EV to EBITDA will be for the company. Second, I looked at the reinvestment, the net capex. The higher my net capex given my growth rate, remember I'm holding the growth rate fixed, the lower my EV to EBITDA. The more efficiently this company delivers growth, the more I'll be willing to pay for it. And the third is actually a variant on the second one, where I looked at the return on capital at this company, and if it can earn a higher return on capital, which is just another proxy for the quality of growth, I'd be willing to pay a high EV to EBITDA. Okay, so here's what I'm going to do. I'm going to play the role of an analyst, and I'm going to tell you the stock is cheap based on EV to EBITDA, and I want you to just ask me questions. So I've come to you with a stock trading at 4 times EBITDA. That's insanely cheap, right? So what's the first question you would ask me?
What would Chris trade at?
6 times EBITDA. So that was my easy question. That's all you asked me. So basically I had that lined up. I was ready to go. I was hoping you'd stop at that question, but what's your next question going to be?
What are its margins?
Its margins might be helpful if I'm looking at revenue multiples. I could give you the margins, but you probably will very quickly get off in a side path. Remember the previous page, we set the variables that determine EV to EBITDA. So first thing you're going to ask me is about my tax rate. Don't forget that. Let's get that out of the way. What was my effective tax rate last year? 9 times out of 10, it's going to be a number like 45, 50, 52%. So you're hoping for low EV to EBITDA. So I say, okay, your tax rates were not bad. So let's assume that you passed the first test. So what's the second question you're going to ask me? Low. So you're going to ask me about my tax rate. You're also going to ask me about my growth rate. Am I a low growth or a high growth company? Maybe I'm a negative growth company, right? Then you're going to ask me where I'm located, because that'll tell you something about my cost of capital. Maybe I'm an emerging market company. And then you're going to ask me what kind of return on capital. You don't even have to ask me about reinvestment, because the return on capital is going to answer that. And if you're a low EV to EBITDA, your returns on capital are probably abysmal. So here's your mismatch. You want a company with low EV to EBITDA, low tax rates, high return on capital, high growth, and low cost of capital. Try it out in Capital IQ. You can screen for companies, see what comes out as looking cheap. The name of the game here, as I said, is mispricing. And now move to EV to sales ratios. Again, by now you get the technique, right? EV to sales, I go back to a DCF model. So in this case, a 2-stage model, because I already have it developed. I go through, and essentially this is a variable, and I come up with the variables that drive the EV to sales ratio for a company. And guess what? It's affected by reinvestment rates, cost of capital, and growth rates, like any other enterprise value multiple. But see the variable that pops up when I do EV to sales? It's operating margin. The higher operating margin, the higher the multiple of revenues I'm willing to pay for your company. You want companies with low EV to sales and high margins. That's a mismatch that's going to drive your investing, not just low EV to sales ratios. I'm actually going to use this EV to sales ratio to go off on a little tangent. Remember in the second or the third session, I did that experiment where I brought in an envelope and I put brand name on there? And I said, don't pay for brand names as buzzwords, that brand names have value. Do you remember what I said about the power of a brand name? What does a brand name give you? Pricing power. You get to charge a higher price for exactly the same product. Yesterday I walked into CVS. I had to get some Advil. And of course there's Advil, and right next to it is the CVS version of Advil. You can check the ingredients, exactly the same. The Advil costs a lot more than the CVS version. I was tempted to reach for the Advil still, but I did get the CVS version. But that's pure brand name power. So if you ask me to value a brand name, remember this is the big accounting, what accountants are seeking to do is bring brand name on. And you say, can you value brand name? The answer is yes, but it'll take some estimation. It'll take some backing up. So I'm going to talk about the value of a brand name in terms of pricing power. Because where does pricing power show up? As higher margins. And higher margins show up as higher EV to sales ratios. If you ask me to value brand name in a company, I could value it with the pricing power built in an EV to sales ratio. And then say, what will happen if the margins drop, and give you a different EV to sales. And at least in a very generic sense, I can say this is the value of your brand name. It's the difference between these two multiples. So about 15 years ago, somebody who went through this class a long time ago, has now risen up the ranks in Coca-Cola, asked me whether I'd come into Atlanta and talk about Coca-Cola's brand name value to its top managers, because accountants were talking about putting brand name and they were very interested in how much brand name is worth. So I said, okay, I'll come in. So I did a discounted cash flow valuation of Coca-Cola. So I'll cut to the chase. I came up with I put in high margins, high return on capital, high growth rates, and came up with a value of about $80 billion. I finished my valuation, and a guy in the front row, the head marketing honcho at Coca-Cola, puts up his hand and says, you forgot something very important. I'm wondering, what did I forget? A division, a beverage, a geography. So what did I forget? He said, you've forgotten the fact that Coca-Cola is one of the most valuable brand names in the world. I said, okay. What exactly do you want me to do? He said, you should be adding at least a 20% premium to that 80 billion. I said, why? He said, because that's what we do at Coca-Cola. Is when we buy brand name companies in other countries, we value them and we add 20%. I said, just because you do stupid things doesn't mean I have to do stupid things as well. He said, don't you think our brand name is worth a lot? I said, it's the only thing in this damn building that's worth anything. What else is worth it? The taste, the flavor, nothing else here is really worth much. And he said, so why aren't you adding a premium? Why am I not? It's already in there. Where? Every single number. Do you think they give you these high margins because of the taste? And those high margins are giving you high returns on capital, high growth rates. It's in every single number that I used. He said, I don't believe you. This is the problem with marketing people. You got to come prepared. And I came prepared. I knew this was going to be an issue. And here I got lucky. I said, let's play a game. Let's suppose tomorrow we wake up with selective amnesia and the only thing we don't recognize is the word Coca-Cola and the red can that goes with it. Overnight, your brand name is gone. You become a generic soda company. It's every marketing person's nightmare. Let's make it come true. What will happen? Tomorrow, you'll wake up, no pricing power. You'll be a generic soda company, and here's where I got lucky. I found a Canadian company called Cott. You never heard of it, right? That's because they produce a lot of soda, but they never put their name on it. They let supermarkets put their... So when you see a supermarket generic soda, it's probably produced by Cott. It's a generic soda maker. It spends nothing on advertising, has no pricing power. Its margins are 5.28%. Do you know what I did next? I said, what if Coca-Cola's margins became those generic margins of 5.28%? That's going to make their margins lower, but it's going to have a ripple effect. Low margins will beget low returns on capital. Low returns on capital create low growth rates. The value that I got for the company stripped off its brand name was about 15.4 billion. You want me to give you a brand name premium? I just did. The difference between those two numbers, 64 billion of your 79 billion is because of your brand name. Don't ask me to add a 20% premium on top of it. I'm going to make a general statement about discounted cash flow valuations, and it comes from a very old commercial that's no longer running. It's a commercial for ragu spaghetti sauce that used to run in the US. It might be on YouTube somewhere. In this commercial, here's what happens. The commercial opens up, and this 45-year-old Italian guy walks into his mother's house for dinner. Looks like a big-time loser because it's obvious he shows up at his mother's house for dinner every single night. And she's in the kitchen toiling away, stirring a pot of spaghetti sauce. She's surrounded by empty bottles of ragu. And he says, Mom, what are you doing? She says, I'm making your dinner. She says, from a bottle? You always used to make it from scratch? And he starts listing all the ingredients in spaghetti sauce. I'm not that good at spaghetti sauce. If any of these ingredients don't belong, take them out. And they should belong, add them in. So he starts, where's the tomatoes? It's in there. Where's the oregano? It's in there. Where's the garlic? It's in there. Where's the cayenne? I'm Indian, I throw cayenne into everything. It's in there. And by the time he got through the list, her response was, it's in there. And you know what? When you do a discounted cash flow valuation, that should be exactly the answer you get when people say, where's the brand name? It's in there. Where's the great management? It's in there. Where's the patents we own? It's in there. If you've done a discounted cash flow valuation, there's no garnishing at the end of the game. It should already be in there. So when you look at the value, there is that difference in value. You know why it was so easy to value brand name in Coca-Cola? Because it's their only competitive advantage. If you ask me to value brand name in Apple, it's going to be a lot more difficult. Why? Because you could argue that its competitive advantage include brand name. It could include John Ives, the coolness factor, the design. It would include the fact that they control the operating system. You could have 3 or 4, in which case I can give you the bundled value of all of those competitive advantages but I can't tell you how much each is worth. And frankly, I don't care. I get the whole package. What do I care at Apple how much is due to each competitive advantage? So you're saying, why do we talk about it? Because accountants are going down that road. They're trying to break down competitive advantage into pieces, and I can predict safely that this will not end well. Because you're going to be double counting, half counting, you're going to be doing strange things because you really cannot draw that degree of it. Have you heard of Interbrand? It's this London-based outfit that every year lists the 10 most valuable brands in the world or the 20 most valuable brands. You know what the most valuable brand was last year? I think it was a tie between Apple and Google. You know how they compute that? They just take the multiple of revenues that a company trades at versus the average for a sector. They take the difference and multiply by the so if you're trading at 10 times revenues, the typical company trades at 2 times revenues. They take the difference, 10 minus 2, 8. They multiply your revenues by 8 and say that's your brand name. It's an absurd argument for brand name. Because what you're capturing in Google and Apple's numbers then is not just brand name, but all the rest of the stuff. They've actually called me a couple of times to say, can we finesse this? And say, you can't finesse it. It's a bundle of competitive advantages. They're inseparable. It's not like I can split away the design factor and leave the rest in there. It's a combination of factors. You can tell me how much that combination is worth. In fact, you're saying, what if I cannot find a generic company? There's actually an easy path you can take. You can argue that any excess returns you earn come from a competitive advantage. So you revalue a company assuming its return on capital is equal to the cost of capital. You're going to get a much lower value for a brand name company. That difference is the value of your brand name. So I'm not going to bore you by doing any more algebra, but you can see that I can take pretty much any multiple. Even an enterprise value to writer, if you want to try it out, what would drive the enterprise value to writer? You're going to very quickly be able to list out the variables that determine it. Okay? So with every multiple, you do the algebra. Not only will you get an equation that you can use to get that multiple, but that to me is pointless. You can't use that equation because it'll just give you a dividend discount model, but you'll also get the variables that determine that multiple, which I think of in two ways. These are the questions I need to ask when somebody tries to sell me something based on that multiple. But it's also what I have to control for when I use that multiple to price a company. Okay. Any questions on? So define, describe, analyze. Let's apply. Okay. Now to apply a multiple, I need to make two judgments. First is, given the firm that I'm valuing, what are my comparable firms? Right? At first sight, you might say, that's a given. We know what that is. But when you sit there with capital IQ trying to pick your comparable firms, you're going to see yourself making judgment calls. Should I stay geographically focused or should I look beyond my geography? If you're looking at a Brazilian firm, you might say, I want to look at only other Brazilian firms, or do I look at Latin American firms? When you define your business, do you define it narrowly or broadly? If you're an entertainment software company, should you look at just other entertainment software companies or all software companies? Okay. So there's a subjective component that you have to drive. But embedded in all of these components is the assumption that when you look for comparable firms, there have to be other firms that are in the same business you're in. That seems to be almost a belief that's taken for granted. If you have a software firm, it has to be compared to other software firms. If you have a utility, it should be compared to other utilities. My question is why? What's so special about sector? In fact, from a valuation perspective, a comparable firm is one which has similar cash flow, similar growth, and similar risk to my company. It might not even be in my sector. After all, what software company is comparable to Microsoft? We can keep trying. It's Adobe gets close. But maybe we should be looking at companies in other sectors that dominate the business, have huge margins, and a couple of cash cows that keep delivering those margins. So we're going to revisit that assumption that comparable is in the same sector. And no matter how careful you are about these comparable firms, there will be differences between your firm and those firms that you have to control for. Right now, how is it done? With storytelling. Much of equity research, you'll have a PE ratio for your company, a PE ratio for the sector, and then you tell me a story about why it's okay or why this company is under or overvalued. I'm going to argue that that will get you only so far. So here are some of the choices that you'll have to make, and think of this as the next template for what you have to get done on your project. So to price your company, you have to come up with a sample of companies that you call similar. And you're going to face two choices here. One is you can define comparable really strictly. and say, I want companies in the same geography that they do the same things I do, have similar market caps. So think of adding those screens in Capital IQ. You're going to come up with a really small sample of companies which are more like your company. The alternative is you redefine comparable more broadly. You'll end up with more firms. So bottom line is, in sampling, you have to decide whether you want a small sample of companies more like yours or a larger sample of companies where there are differences that show up in your sample. It depends on what you plan to do with that sample. If you just plan to compare P/E ratios across companies, you don't want to do any controlling, then you're probably better off with a smaller sample. In fact, at the limit, you know that auto analysts in the US for about 80 years in the last century had only 3 companies in their sample. They were GM, Ford, and Chrysler, and they went back and forth between those 3 companies. Why? Because they basically told stories. They just compared the P/E ratios or price to book or EV or whatever they used across those 3 companies. So if you plan to just tell me stories, you probably want to keep the sample small. But if you have a larger sample, it's true, you might not be able to tell stories, but you might be able to control for differences. And to control for differences, you will need to draw on your statistics. So you're going to see me try to use statistics, like I did in the last session, to control for those differences across time. Second, when you control for differences, as I said, you can do direct comparisons. That's what I did with Uber and Lyft, paired comparison. I did it partly because I was desperate. There's nothing else out there. But in a paired comparison, there's only so far I can run. It's a sample size of 1. I'm taking what the market had as Lyft's price last Friday, extrapolating to Uber. I can do storytelling. I could tell you that Uber should trade at a higher multiple of net revenues. Why? Because per rider it gets more revenues than Lyft does. Or I could tell you Uber should trade at a lower multiple. Why? Because it's in riskier countries. Its biggest market now in terms of growth is Latin America. It's abandoned Asia because it gave up on it. Europe has always been this thicket that they can't want to deal because they get banned and unbanned and banned again. But Latin America now is almost 20% of Uber sales. I haven't been to Brazil in 2 years, but it'll be interesting to see how accessible Uber is across Brazil or Argentina. But if you look at the numbers, it must be available in a lot more countries. So you could argue it's in riskier countries, maybe the multiple should be. You see the problem with storytelling? Depending on what I want to tell you about Uber, I can pick that angle in the story that best fits my story and run with it. The third is I can try to do what I did with PEG ratios, bring in that worrying factor into my multiple. And finally, I can use statistics. I can control for the differences statistically. So let me start with a very simple story. As I said, I'm going to play the role of an equity research analyst, a very naive analyst, and feel free to shoot me down because I'm going to make some really stupid recommendations based on on statistics. So here's my first try. I'm the beverage analyst, and this is my sector. And I put out a buy recommendation on 3 stocks. The first is a company called Andre Wine. Have you heard of this company? They usually run their commercials just before Christmas. It's champagne that's so cheap, you get a headache watching the commercial. Right? It's basically like $3 big, might as well be in paper cups, right? So Andre Wine. The second is Todd Hunter, which I have no idea what they do. And the third is Hanson Natural, which is, you've seen the natural sodas. Why did I pick those 3? They had P/E ratios less than 10. Remember, I told you I was a naive analyst. I just like those companies because they trade at low P/E ratios. So should be done. What might I be missing? We'll come back and deal with it in more depth. But even at first sight, what's the problem with Andre Wine and Todd Hunter and Andre Wine? The problem is low growth. Hanson looks pretty good, right, in terms of growth? What's my concern? It is high risk. I'm not saying you talk yourself out of investing, but I'm saying, hey, P/E ratios are low for a reason. Once I control for the low growth and risk, we can revisit these comparisons, but by itself you can see why just picking stocks based on P/E or price to book can give you some very strange conclusions. So I get fired. So if you look at these stocks, you can see again, when I look across stocks, I need to control for differences in growth and risk. And there's very little I can do with the storytelling. Right? I can say on the one hand is low P, on the other hand I have a low growth rate. Then I run out of hands. What do I do then? Right? I can't tell you to buy or sell because I'm kind of stuck. So now I get fired. I'm now the telecom analyst, and this is the late 90s. And look at the telecom sector in the US in the late 90s. You had a bunch of ADRs of foreign telecom companies that had been listed in the US. Remember, prior to the 1990s, most telecom companies outside the US were government owned. And they all got privatized, and so these are the ADRs. You ready for my next set of recommendations? I'm going to suggest you buy Indosat and Telebras. Indosat is the Indonesian satellite company. This is the late 90s. And Telebras, of course, was the original Brazilian telecom company. It's since been broken up into pieces. But I like them. Why? Because they trade at less than 10 times earnings. You can see my pattern. This is all I know how to do. So you put me in a different sector, I go back to what I know how to do. Here again, the answer is pretty straightforward, right? One is that they have low growth. You know what the other concern I should have is? You have an Indonesia and a Brazilian company. Look at the rest of the sample. You have some European telecom companies. And this was in the 1990s when emerging market companies were really emerging market and developed market companies were really developed markets. I'm concerned about low growth and high risk. I've run out of hands, right? On the one hand, on the other hand, the third hand, the fourth hand. So basically I open up my statistics book. What is it I'm trying to explain? Differences in PE ratios. What are the things that worry me? Growth and risk. I ran a regression. I ran a regression of price earnings ratios against growth rates and risk. Okay. For the risk, here's what I used. I used what's called a dummy variable. You know what a dummy variable is? It takes on a value 1 or 0. I put 1 for any emerging market telecom, 0 for a developed market telecom. I ran the regression. I got an R squared of 66%. Good R squared? Statistics classes ruin you for life. Because in statistics classes, everything you do has a 95% R squared. I'll tell you something. If you're running regressions with a 95% R squared, you're wasting your time. You're regressing things that are obviously connected to each other. Like what? Like what is your GPA and how many cans of beer do you drink every week? I'll make a safe prediction. You drink more than 50 cans of beer, your GPA is in the toilet because you're never getting out of bed. Or what's the relationship between how much you eat and how much you weigh? You eat 15,000 calories a day, you're going to weigh a ton. But they think that if they show you anything less than 90% R squareds, you're not going to be convinced. I'll tell you, in finance, 66% is about as good as it's going to get. In fact, 20% is what you're going to settle for when you do your company. In fact, you keep lowering your standards as you go through. More important than the R squared are the T statistics. Remember T statistics? You kind of you said, I've left that behind, you remind me. What's the level for the T statistic you need for something to be statistically significant? So let's make it 2. If your T statistic is more than 2, you're saying, okay, but remember, statistical significance can still go with a low R squared. But if you run a regression, the T statistics are all 0.3, 0.4, your regression is pure noise. So in this regression, the T statistics are all significant. My R squared is 66%. Let's read the output from the regression. What is that 13.12 intercept? Tell me. All it tells me is something about the general pricing in the sector, right? If everything's priced high. So basically the intercept is my starting point. It's something that captures the overall pricing of the sector. That's my base. The 121.22 coefficient on growth, here's what it tells me. Every 1% increase in growth rates for a telecom company in the 1990s increases the PE ratio by roughly 1.21. So if your growth rate is 5% higher than mine, guess what? Your PE ratio should be about 6 higher than mine. Not only can I now tell you how much growth matters, but I can also translate into what it means for your PE ratio. And then I looked at my emerging market dummy variable, minus 13.85. What does that tell me? You have 2 telecom companies with the same growth rate in the late 90s. The emerging market telecoms companies' PE ratio will be 13.85 lower than the developed market telecom companies. That's a pretty hefty discount, right? Remember in intrinsic valuation, we try to bring in country risk through country risk premiums and discount rates. When you're pricing things, you know how you bring in country risk? You look at how much the market is punishing countries for country risk. And if you find the market's not punishing countries for having country risk, guess what you do? You ignore it too. The name of the game in pricing is you go with the market. You've already chosen that path. You can't selectively take some things and reject them. In the late 90s, the market was really punishing companies which were emerging market companies. Now, why am I doing all of this? because I wasn't sure whether Indosat and Telebras were cheap or expensive, right? So I took Telebras, and I plugged in Telebras's growth rate, which is 7.5%, and the fact that Telebras is an emerging market company. So I'm taking the regression equation, getting a predicted PE for Telebras of 8.35. It's trading at 8.9 times earnings. It looked cheap to me, but after controlling for the low growth and a high risk, guess what? It's actually overvalued by about 10%. And that is the advantage you get when you bring statistics into the game, is you can control for the things that bother you. And remember, this is pricing. You can control for whatever bothers you. Like what? If you're looking at banks, you can say, I don't like the fact that this bank has low regulatory capital ratios. You can throw that in. If you're looking at a retail company, you say, I don't like the fact that this company has same-store sales growth that's low. You can take the things that worry you in your sector and throw it in and see if it makes a difference. So I get fired as a telecom analyst. I'm now the banking analyst, and my sector is European banking. I've had to move continents because my reputation has been ruined in the US already. Nobody in Europe seems to know me. I'm the banking analyst. And this is my sector. So there are the European banks, there are the price to book ratios, and I've kind of given away the game. I've given away the return equity at these banks and the standard deviation. So give me a perfect match. What do you want? You want a low price to book, low return equity, high return equity. High return equity and low standard deviation. I'll give you a very simplistic way. Let's say you don't like regressions, or you have a client who doesn't like regressions. Here's a simplistic way to look to come up with what you're looking for. I came up with the median price to book ratio, the median return equity, and the median standard deviation. So what am I looking for? I'm looking for a stock that trades at less than the median price to book, has a return equity higher than the median return equity, and a standard deviation lower than that median standard deviation. So let me put you back on the previous page, right? So the median price to book is 2.07. So you can knock out anything that falls below Societe Generale, right? They're all price to book above 2.07. And then you look at the companies above Societe Generale. I think only one of them earns a return equity. I think the 11 is BNP Paribas. But the standard deviation is higher. So I can't find any undervalued banks, at least based on that very simplistic exercise. And I can do the same thing with overvaluation. I can look for stocks that trade at a high price to book, have a low return equity, and have a low. So essentially, you can look at that combination of mispricing and come up with it. But you can see why eyeballing the data, which is what much of equity research is now, is eyeballing the data can be so extraordinarily dangerous. Because you almost never will find a slam dunk company. A company which, just from the eyeballing, said that company looks cheap. And as I said, you're not constrained by any of our definitions of risk from intrinsic valuation. If you want to define risks differently in your sector, maybe your sector is one where some companies have lots of customers and some companies have relatively few customers, and you worry about the fact that if few customers, losing one is going to be more risky. You can throw that in the sample. Anything that you want to talk about as something that you worry about, just throw it into the regression and see if it actually does matter. So finally I said, you know what, I can't eyeball this data anymore. I took the price to book ratios for banks and ran a regression against return equity and risk. I now have an equation that tells me how much every extra 1% return equity a bank translates into a higher price to book ratio of about 0.036. Every 1% increase in the standard deviation knocks the price to book ratio. So the signs on the coefficients are in the right direction. As I said, don't always expect that. The R squared of the regression is 79%. The T statistics all pass my significance test. I'm going to use this regression to get predicted price to book ratios for every company in my sector. Just plug in the numbers, and then I compare my actual price to my predicted price to book. And I get a measure of whether my stocks are more likely to be underpriced. I'm not going to use the word valued anymore, underpriced or overpriced, given where they're being priced at and their return equity and risk levels. Now these regressions that I've just run are linear regressions. You know what I mean? Basically I'm just running. And linear regressions work if the relation, this is going to be a throwback to statistics you don't want to have, but I'm going to drag you there. If the relationship between two variables is linear, linear regression works. But one of the things in valuation is there might be a relationship between price to book and return equity, but might be non-linear. You know what I mean by non-linear? Doubling your return equity will not double your price to book. It might be a higher number. You're saying, how will I know? Just graph out the data. When you put the data up, you see a curve in there. You got a non-linear relationship. I'm going to give you a trick that works for me. It might not work for you. Whenever you have a non-linear relationship, try using the square root of the number. It seems to work. I know there are all these neat transformations you can do on your variables. This tends to work for me. Using the square root of a number reduces the divergence in that number, makes the relationship more linear. So if you throw a market cap in there because you think it matters, and there is a relationship but it's messy, take the square root of the market cap. It seems to work reasonably well in coming up with the price to book ratio. So now, I got fired as a banking analyst. I'm now a market strategist. I'm the big quant guy. Where did I get to be the big quant guy? Because I've screwed up in so many different other places. They can't trust me with the small quant stuff. They move me up the ranks. So my job is to find the cheapest, largest market cap companies. So this is from January 2010. I took the price to book ratios and return. This is actually very easy to do. You can pull the numbers from Capital IQ, pull the price to book return equity. And they'll all be big names. So I graphed them in. Basically I put everything into a graph. You're saying, what are these three lines? The middle line is actually the regression line that I fitted through. So from running the regression. The two outer lines are my 90% confidence intervals, which means given the noise in the regression, anything that falls between those two lines, I cannot reject the hypothesis that they're fairly valued. So now here's my question. There are some stocks that fall above the line and some stocks that fall below the line. It's the easy part of the question. Which ones are undervalued and which ones are overvalued? The ones that fall below the line, above, which ones are undervalued? The ones that fall below the line or above the line? Below the line. So based on this regression, what are my cheap stocks? ConocoPhillips, Nokia, and ExxonMobil. I'm starting to get a little worried. Why? Two of my three cheap stocks are oil companies, and you know what that leads me to believe? That if oil prices drop during the last 3 months, what's going to happen? The market guy, but you might actually be getting a return equity that reflects a much higher oil price. I'm not saying, so you can already see that when you screen, you're not getting your final picks, you're getting picks that you want to do more research on. What comes above the line? What are the three stocks? Google, Infosys, and Gilead, which were all high growth companies. You see the other missing variable here? I'm looking at price to book and return equity. I'm not looking at the third dimension of growth. So I'm concerned about risk, I'm concerned about growth, but in this scatter plot, I'm missing one or the other. So I'm going to do something that I've found to be remarkably non-helpful. But the picture is so much fun to draw that it's still going to be worth looking at. You heard of three-dimensional scatter plots? You get dizzy just looking at them. It's like looking in a cardboard box. So with price to book return equity, you knew what you were looking for, right? Above the line or below the line. In this box, you're looking at corners of the box. So tell me what combination, or which corner of this box I'm looking for my bargains. Let's start. You want low price to book or high price to book? Low price to book. So it's this half the graph. Low return equity or high return equity? You want to go there. Low risk, low growth or high growth? So basically you're looking in this corner. There's nothing there. But are you surprised? What was the sample I looked at? 100 largest market cap stocks, right? If I tried this on 100 very lightly followed stocks, you never know. The reason we screen is we don't know. And there's no harm looking. In fact, here the closest thing I get to a cheap stock is Time Warner. And it's not that cheap. So one of the interesting ways in which you can look at these visually rather than running regressions is to look at them on three-dimensional graphs. In fact, I got a little carried away. I said, what if I want to... You're saying, why don't you just do a four-dimensional graph? I can't even visualize, grab my mind around a 4-dimensional graph because my mind can think in only 3 dimensions. So I can do only 3 at a time. That's part of the problem with these graphs. Is here I looked at price to book, risk and return equity. And here again, let's think about cheap. So you want low price to book, you want high return equity, but you want low risk. You want something in this corner of the box. The closest I get is ExxonMobil, but it's not that close. So again, if you don't like regressions, you can look at this visually. And you know what? 30 years ago, doing these graphs would have been a pain in the neck. Today, you can sit there in Excel and do 2-dimensional, 3-dimensional. And if you invest in any good statistics package, you can do some really good-looking graphs. But really, the key here is as you learn to use these graphs, you learn that this is a way, because here's what, I'm a believer in intrinsic valuation. But how many publicly traded stocks are in the world? About 43,000. If I start at A and decide to work all the way through Z and say I'm going to value every stock, I'll never get done. I have to decide on a subset of stocks where I'm more likely to find something interesting. You know how screening helps me? It gives me a subset of stocks. Those 5 or 10 companies where something funny is going on, say, hey, go take a look at those companies. So I took these 100, the largest market cap stocks. I ran a regression, and this is the advantage of regressions. I can bring in everything I worry about, not just 2 variables, against beta, growth, and return equity. So let's read this regression. So this was in 2010. My base is 0.41. The market was fairly low priced, and you saw the base reflected. Every increase in beta of 1 reduces my price to book ratio by 0.07. Every increase in my growth rate increases. So basically all the coefficients have the right sign. They all have t-statistics except for the beta. Don't take the constant out because it is a low t-statistic. That doesn't have it's one of the things that gets its free pass. But if I were to rerun this regression, I'd probably take the beta out. In fact, I'll take the beta out. You know why? Because by putting the beta in, I'm just adding noise to my prediction. So when you run a regression, you don't have to leave everything that's supposed to be there in there. No? So if I reran the regression with just return on equity and growth rate, I'd probably get a much stronger prediction. But what am I going to use this for? I can get predicted price to book ratios for all of those large market cap stocks, complete the process. Then what do? I compare the actual price to book. I come up with the 20 most undervalued, 20 most underpriced. There, I slipped already. 20 most underpriced, 20 most overpriced. And I can be a one-person hedge fund, right? What do? I buy the 20 most underpriced, I sell the 20 most overpriced, and I hope and pray that I move towards a regression line. That's a part that's not in your control. But that's effectively what quant models are bringing to hedge funds. Because this is just the opening in statistics, right? You bring in an MIT grad. I mean, he's coming in with a stat toolkit and models that he can use. I think they're getting a little too carried away because all of this is still conditional on that past data being a predictor of future data. But that's exactly where quant models are taking us. They're taking large amounts of data and they're adding these extra refinements in statistics to find what's underpriced and what's overpriced. So here's my January 2019 update. Okay. The cheapest stock, the only stock that fell below the line is Verizon. Don't do anything crazy. Okay? Don't sell off everything in your portfolio and buy Verizon. But there's something off about Verizon. Something is causing the mismatch. Now if I wanted to go any further, what would I do? I'd do an intrinsic valuation of Verizon because that's where my philosophy takes me. But that's the only stock. If you look at the overvalued stocks, you have Amazon, Netflix. What's MA? I don't know. Did you know? MasterCard? Maybe it's Master. Yeah, I think it is MasterCard. Those are my 3. Well, Amazon and Netflix are fairly easy to explain. They've been above the line for the last 20 years or the last 10 years. The problem is if they stay above the line, you never make money. But they're above the line. MasterCard is interesting. Now maybe it's time to twin MasterCard. You know, one of the company that that many of you are doing is Square. I think 8 of you are valuing Square. And for obvious reasons, it's a place to go, it's payment processing. You take Square, PayPal, and MasterCard, you're taking essentially 3 companies at this different stages in the life cycle. But it's interesting, the market seems to be pricing MasterCard as if it is one of these growth companies. Okay? Worth examining. So I get fired as a market analyst. I can't seem to keep a job. So final job, and this is, I think, my last stop before I get fired completely.
These large companies
Yeah.
follow track very well,
Yeah.
so it might be a fair assumption that they are well tightly.
I would start out with the presumption that's probably something I've missed. But I'm not going to stop with that presumption, because even with large companies sometimes, mood and momentum can drive a company way below what it should be. The pricing game is not about stopping where it's sensible. It's often selling things off. I wouldn't be surprised if Boeing showed up below the line very quickly, and it might show up for the wrong reasons. People are overreacting to whatever's happening in the near term and knocking it down. But you're right, you're less likely to find massive mispricing in this sector.
But this will be a good equation. The equation will be good. I can take it and apply to less.
That I'd be more careful about. Statistics, your equation is only as good as the data you got it from. It's not going to extrapolate. So I'm going to give you a different regression, which is market-wide. Don't take the large market cap companies and apply them to small, because it might be a very different relationship there. You know. Yeah.
Then we cannot, again, then we are going to the market. So
This is still the market. It's just a subset of the market. You're actually doing something very dangerous. You're taking a pricing for a subset of the market and extrapolating.
this is a good.
Yeah. So why not do it right? If you're going to do pricing, might as well use the whole market. So now I'm the trucking analyst. Incredibly boring sector, but remember, I've run out of jobs. So here's my trucking sector, and you can see that I've computed the EV to EBITDA in the last column. So I'm going to put out a buy recommendation on Ryder Systems. It's trading at 2.8 times EBITDA. It's the second lowest. I have no idea what KLLM transportation service. So I went with a company that I recognize. You're familiar with Ryder, right? You see those trucks all over the place. Now, before I ask you to make a, I'll ask you to ask me questions, I'm going to tell you something about the sector that is worth remembering as you look at these multiples. This is a sector where you have fleets of trucks that get replaced every 3 or 4 or 5 years. So rather than replace a portion of the fleet each year, they prefer to replace the whole fleet. Why? Because you get a bigger discount when you buy them in bulk. So file that away. You're saying, who cares? So basically, every 5 or 10 years, there's a replacement of the entire fleet. So EV to EBITDA, ask me the question. What's the first question you're going to ask me? You're going to ask me something about tax rates, and I'm going to say these are all US companies, roughly the same tax rate, off the picture. You're going to ask me something about return on capital. I'm going to say they're all pretty mature companies earning pretty close to their cost of capital. You're going to ask me something about growth rates. The growth rates are they're all pretty mature companies, all low growth rates. So which leaves you with not too many questions, right? What's the final question you're going to ask me? When was my fleet last replaced? You see why that matters? Because if you have to replace your fleet every 5 years, here's what's going to happen. You're going to replace your fleet. So as you get, right after you replace your fleet, you might have, so as you get closer and closer to replacing your fleet, you're going to look cheaper and cheaper to me. I buy Ryder Systems, and tomorrow I open up the Wall Street Journal. What am I going to read? That Ryder Systems has issued $10 billion in new debt to buy new trucks. You know what? Trucking companies actually report the life of their fleet, the average life, in their annual reports. I pulled this actually from an equity research report that asked me to buy Ryder Systems, saying it looks cheap. All that analyst had to do was pull up that extra column and put the life in, and he'd very quickly have seen that what caused the low EV to EBITDA was the fact that they had the oldest fleet in the group. Remember I said the problem with pricing is not that it's done, but it's done sloppily. People are lazy. They just won't apply multiples. There's a good way to do pricing. Use the data, and you have no more excuses. The data is right in front of you. And that's something you want to think about whenever you look at an equity research report. So let's move on. And this is about how and why companies look cheap or expensive over time. So this is a price to sales ratio. Internally inconsistent, but I'm going to live with it because these are grocery stores. They all have the same debt ratio. I could have done the same thing with EV to sales. So in 2007, I've graphed out the price to sales ratios for grocery stores. I've drawn the line. I've drawn the two barred lines. And most of them kind of hang out together, right? They have all pretty low multiples of revenues and pretty low margins. See the outlier? That's Whole Foods. So tell me the story. You're an equity research analyst. How in 2007 would you explain the Whole Foods being priced so much more? Much higher margins, therefore. And this is the problem with storytelling. So you can say, okay, but why so high? So here's what I did. I took the net price to sales and ran a regression against net margins in this sector. And when I plugged in Whole Foods net margin in there, I got a predicted price to sales ratio of 0.53. They were actually trading at 1.41 times sales. So if I trust my regression, what would that tell me? Even with the higher growth rate, they're overpriced. We take you forward to 2009. Remember Whole Foods, the same sector 2 years later. Where's Whole Foods now? It's actually the most underpriced sector in the market because it's not quite underpriced, not below the line, but it's actually the closest to the line. Whole Foods has gone from being most overpriced to close to the most underpriced. In fact, if you take their actual price to sales ratio 0.31, it was much lower than the average of the sector. So it's gone overpriced to close to underpriced. Let's keep going. 2010, I look for Whole Foods. I know it's a very crowded graph. It's actually right on the line. This is one of those things. This is great. This is the way the world is supposed to work. With Whole Foods it did, right? You went from overpriced to underpriced to correct pricing. You say, finally the market figured it out. And there's reason this happens when you have a disruptor in your business. Because what do? You treat that disruptor like you did, and then you say, this company is special, you attach special metrics to it. At some point in time, though, they come down to earth. They're treated right. Now, right now, Tesla in the automobile space, if you're an auto analyst, you really don't even know what to do with Tesla. Because every metric you've developed is for those old, declining auto companies. So early when a disruptor shows up, this often is the case. And I wouldn't be surprised if people don't know what to do with Square right now. In fact, many of these companies look so different from the Visas and the MasterCards you've been used to, that you basically throw up your hands and say, any price is okay because the story tells. Yes?
It's actually over the line, right? 0.5?
It's above the line. It's gone back to being overvalued. Never mind, I jumped ahead. So now there was actually, I think I missed a graph. There was a final graph where it came back to the line. When overvalued, undervalued, overvalued, finally it came back. And then you get to 2015. Whole Foods is now looking more and more like traditional grocery stores, but notice there's a new kid in town. Sprouts. Sprouts is now the high growth, organic place to be. But if you're Sprouts, don't rest too long in your laurels because there'll be somebody else who pops along because people will get used to adjusting for your differences. So when new companies enter a sector, you're going to see them often be mispriced badly. Which means if you're looking for opportunities, those are the companies you should be thinking about valuing from the inside out. So there's a good reason to value Square right now. People don't know what to do with it, which means they might be massively mispricing it. Finally, I've lost all my jobs. And the only job now is to be the .com analyst. God help me. So I've learned my lessons. I've been told you should graph this out, so I brought scatter plots now as a tool. I put a scatter plot of .com stocks, and it looks like a shotgun blast. Try fitting a line through this. It's almost impossible to do. So our price to sales and margins, and everything in the textbook says high margin companies should have high prices. It doesn't seem to work in the sector. But undaunted, I'm going to use the tool I came to use. I run a regression, and I found something not surprising. My R squared is only 4%, and here's even more scarier output. I have a negative coefficient on net margin. How would I read that? The more negative my net margin, the higher my price to sales. If you are writing a book on irrational exuberance, this could be exhibit 1. Look how crazy people are. The more I lose, the higher my market price goes. And there were some companies in the late 90s that took this to heart, right? You lost 2 billion, we can lose 3. You lose 3, I can lose 5. You can burn through 2 billion, I can burn 10 billion. Right? It's like watching Didi and Uber and Lyft burn through cash. But even in the midst of chaos, there's a logic to what the markets do. people weren't buying these companies because of how much money they lost last year, made last year. Why were they buying them? Because of the expectation that they would survive and make money. So I put myself in the shoes of an investor looking at this market, and I threw in 3 variables into this regression. I'll tell you why. One is when you look at the price to sales ratio, some of the stocks trade at 100 times sales. Why? Because they have tiny sales. So my first hypothesis, as revenues increase, the price to sales ratio will decrease. You cannot trade at 100 times revenues when you have 10 billion revenues. I threw the log of revenues in there. I told you to take the square of it. No, I'm sorry. Take the log of whatever variable. Square root will not do it. The log of the variable will actually make your nonlinear into linear. So I brought in the revenues. Second, I threw in the revenue growth rate, arguing that higher growth will lead to higher price to sales. And then I threw in how much cash they had. You're saying why? What happens to most young startup growth companies? They don't survive. And you know why they don't survive? They run out of cash. The more cash you have, the greater the chance of surviving. See these statistics? The revenue really is not statistic, but the other two are reasonably significant. And I get an R squared of 32%. In this sector, that's about as good as it's going to get. I plug in the numbers for, at that stage, Amazon. And this was at exactly the same time. Remember the valuation of Amazon I showed you where I found it to be massively overvalued, 84 versus 35? When I get the predicted price to sales, I found it to be underpriced. How can a stock be overvalued and underpriced at the same time? How would I explain that to somebody who says, how can that be? It's overvalued because I'm looking at relative to cash flows, growth, and risk. It's underpriced given how the dot-com stocks are priced. And guess what? Both those conclusions would have been right in hindsight. Because a year later, what happened to the stock? It dropped 11. But it dropped only 85%. You see, what do you mean only 85%? You know what this entire sector dropped by? Like 97%. When you play the pricing game, that's something you got to factor in. You're just getting the least underpriced stock in the sector. But it might be still overvalued. Okay? So I will continue with this on Wednesday when we come back. Yeah.
When it comes to healthcare companies, so when you capitalize the R&D,
Yeah.
so I sort of got lost in my valuation with sales to capital versus reinvestment versus like which ratios to sort of come up with, because I took finance healthcare, and he sort of goes through the projection how it's you're gonna go through your R&D trials, that will increase over time, and then you'll have an increase in revenue, and then you'll have a drop once the patent, like when you reach the patent cliff. So I was sort of wondering.
Are you modeling a drug or are you modeling a company?
So I'm modeling the drugs because that is the company's name.
But remember, you have to decide. But if you want to model a drug, then you can do all of that. There'll be no terminal value in this place. If your argument is this company is just this one big drug that's working its way,
That's literally what it is.
then value the drug. It's more like a capital budgeting.
Okay.
Than a traditional valuation. There's no terminal value. There's no reinvestment that you need to keep it going other than what you need to keep the commercial product going.
So that was the question I had, because what they're doing is they're essentially taking this one drug and applying it to different diseases.
Okay, so you're going to get an expansion. Can they extend their patent while they do this? Isn't that true? If you find a new disease treatment that you can modify the drug a little bit.
Exactly.
So they might be able to reclaim that life so they can stretch it out.
Okay.
But it still remains.
So,
capital budgeting.
But I shouldn't have a terminal value then?
You should never terminal value. Just project out the drug over a 25, 30-year life and essentially let it scale down. At some point in time, it will become a generic drug.
Right.
At which point you can say, I'm going to just earn my cost of capital and
Okay,
that's it.
because what I did was I essentially projected till 2040 because it expires in 2036.
Yeah, then you're pretty much
so at 2040 I should just stop.
Yeah.
Okay, perfect. Thanks.
I have a question.
Yeah.
The third multiple that you showed was EV to book value?
Invested capital.
Okay. EV to invested capital. Okay, so it's basically...
Because if you think about what goes in the numerator, market value of equity, market value of debt minus cash,
Yes.
then what's in the denominator will be book value of equity plus book value of debt minus
Okay.
cash, which is invested
I thought
capital.
invested capital. I thought I read book value of equity only.
No, that's price to book and then you go to invested capital. Yeah.
Thank you.
Hey, how are you?
Okay, so I saw your graph there, 3D.
Yeah.
And I was just wondering, I mean, I might be completely off, but is it possible to use the Cartesian distance the
Huh?
C, like.
Yeah, as I said, I'm just doing very basic statistics, but you can actually take this. The only thing to do is remember to be a little humble here, because the data is